The Icons of Real Estate podcast. Are you ready to learn the proven money-making secrets from top-producing Icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business. From $3 million to $30 million in just 12 months. Brought to you by the Masters in Real Estate Marketing, Arter SEO.
Welcome to the Icons of Real Estate podcast. I'm your host, Patty Teal. I'm so excited to tell you about today's icon. Thomas Castelli is also known as the Real Estate CPA. He helps others build wealth, achieve financial freedom, and retire securely by investing in real estate. Thomas and his associates are real estate investors themselves, so they have unique insights to help their clients. Thank you so much for being on the show, and welcome, Thomas.
Thank you for having me. It's a privilege to be here today.
Oh, thank you. We feel the same. So usually we start by asking you to share your journey into this field. How did you become this real estate CPA? Would you tell us the story?
Yeah, absolutely. So I was in college and I realized that the traditional path wasn't really going to get me to where I wanted to go. So while I was in college, I started reading books, the Rich Dad, Poor Dad books. I'm sure some people may have heard of those. And from there, the rabbit hole goes pretty deep. But I realized that real estate is something that I needed to be involved in, and I needed to invest in real estate. So shortly after I graduated college, I went to a seminar and my goal was to try to wholesale my uncle's property. So kind of give you some context on that. My great uncle had passed away and he owned a property in Long Island, New York, that was within walking distance. I'm talking about 1 or 2 minutes from a train station that went into Penn Station in Manhattan. And I knew that was an ideal location for a city commuter. And around the block from that was a full shopping center with a grocery store, laundromat, restaurants, everything you would need right around the block in walking distance. And then around the block from that was the village of Bethpage, which is a town village with even more shops and whatnot. So I realized that was like prime real estate and there was something there. And now that was a small house on a relatively large piece of land. And I knew that you can be knocked down and you could build 2 or 3 houses on it. So I went to the seminar trying to get someone to help me either flip it or sell it or develop it, whatever the case was. Long story short, there was issues in my uncle's estate, all these complications that never happened. But at that seminar, I met a group that was doing a 3-day weekend on real estate syndication. And that's where I fell in love with the syndication business model and started investing in deals as a limited partner. And then ultimately was on the sponsorship team of an 82-unit apartment complex in Jacksonville, Florida. And that since went full cycle. So it's kind of how I got involved on the investing side. Then right around that same time, we did that 82-unit deal. I met Brandon Hall, who's the founder of Hall CPA, the firm that I'm currently a partner of. And what he did was, he was putting out a lot of content on real estate tax and whatnot. Mm-hmm. So I reached out to him and was like, hey, look, I have this really big passion for real estate investing and this background in accounting, would love to have a conversation, see if there's a fit. So long story short, gave me a trial period here at the firm, got hired within the first handful of weeks and been helping real estate investors reduce their taxes ever since. So that's kind of how I got started and how I got to where I am today.
That's a great story. You got started with your uncle's property and then you just followed the breadcrumbs after that. And sounds like you were being led to a very successful business. So I went to your website and it was very enlightening. And what really struck my eye at first is that most in real estate investors are leaving thousands of dollars on the table because they don't know of the different laws and tax advantages that they can take. Can you talk a little bit about that?
Yeah, absolutely. So let me just kind of break down the tax benefits of real estate in the first place, because I think it's pretty helpful to set the stage for everything else. Mm-hmm. So when you invest in real estate, it's one of the most tax advantaged assets. And the reason for that, there's something called depreciation, which is a non-cash expense What I mean by that, it's an expense that doesn't take money out of your pocket, but reduces your taxable income. So here's an example. Let's say you had $10,000 of rental income, right? So your tenants paid you $10,000. And then you have $6,000 of hard expenses. And I mean hard expenses, these are expenses that left your bank account and went to a third party. Property taxes, utilities, repairs and maintenance, legal and accounting fees, so on and so forth. But then, so that leaves you with $4,000 of cash flow. Now, in most businesses, you'd have $4,000 of taxable income too. So you have to pay tax on this $4,000. But enter this expense called depreciation. And depreciation, let's just say you have a $5,000 depreciation expense, which is very, very plausible in this example. Well, now you have $1,000 loss on your profit and loss statement. But that's a taxable loss. But the thing is, you made $4,000 of cash flow because remember, $10,000 of rental income, $6,000 of hard expenses, and now you have this $5,000 expense that's non-cash. So you pocketed $4,000, but on your tax return, you're going to report a loss of $1,000. So that's the first benefit of investing in real estate. You're able to shelter your income, your cash flow from tax. Now, the next question is, well, what happens to that $1,000 loss, right? So under Section 469 of the tax code that was put in place under the Tax Reform Act of 1986, it made all rental activities passive by default. So that means that this $1,000 loss cannot offset your active income. There's some ways to do that, and I'm going to get into that. But just for most investors, unless you're working real estate part-time, full-time, just know that this loss is going to not be able to offset your W-2 or active business income. So what ends up happening to this loss is it gets carried forward to future years. And in future years, it can help you offset your income from your rental real estate or the gain on sale when you sell the rental real estate. So that's that for most investors right there. The ability to shelter your income and then carry these losses forward to shelter future income is going to be the primary tax benefit of real estate. Now, most real estate investors don't know how to really take advantage of this non-cash expense because there are ways that you can increase it. You can increase this non-cash expense or accelerate it through cost segregation studies and bonus depreciation. So long story short, what a cost segregation study does is it breaks down the components of your property into its different class lives. Because when you buy a building, it's not just the building. You have sheetrocking, you have flooring, you have windows, you have all these different things, all these different components.
Right.
And the components with a class life of 20 years or less can be 100% or 100% depreciated using bonus depreciation, which means you can expense that all in all in 1 year. So what you do is you get the cost segregation study performed, and now you have this massive depreciation expense that could cause a loss well above what I mentioned before. For example, instead of having a $1,000 loss, you might have a $10,000 loss. Well, there's power in carrying that forward. So I can kind of stop here. I don't know if there's any questions.
Well, there's so much. It just sounds like you'd be foolish not to work with someone like yourself who's an expert at all these real estate, I'll call them loopholes for lack of a better word, because an average CPA probably doesn't know these things.
Right. So the thing is like a lot of CPAs out there, they're generalists. And what that means is they're working with many different clients in all different areas. From manufacturing to online marketing to consulting, all law, legal, medical, all of this stuff. And what happens is they spread themselves so thin, they never really dive deep into any one area and fully understand it. Whereas like a firm like ours, what we've been able to do is be able to niche in real estate. And because we only work with real estate investors, we're able to really fully understand the breadth and depth of the tax code in this one specific area. And really be able to help people. Now, having said that, we do know general business, but I'm just saying, like, working with someone who's focused in one area is going to get you probably the best results.
Oh, that makes total sense. Just like going to a doctor, there are specialists and then there are generalists. And, if you have something wrong with your heart, it's probably a good idea to go to a cardiologist.
Absolutely. Absolutely.
So I also learned on your website that bonus depreciation is being phased out. And so I think it was saying that it's important possibly to invest sooner rather than later. Can you address that?
Yeah. So bonus depreciation. So again, bonus depreciation allows you to accelerate your depreciation expense and generate these outsized losses, which you can use in various ways. And what's happening right now is from 2018 to 2022, if you bought a property, placed in the service, so made it rent ready and listed for rent, you were able to use 100% bonus depreciation. So any items with the class life of 20 years or less you'd be able to deduct that full expense in the first year you bought the property. And that's usually anywhere between 20 to 30% of the purchase price of the property, give or take, and give a ballpark number of what that can be. But starting in 2023, it begins to phase out 20% per year. So in 2023, it's going to be 80% bonus depreciation, which is still quite powerful. 2024, you're going to have 60%, which still packs a punch. But then as you kind of get into 2025, you're looking at 40%. 2026, it's 20%. And then 2027, it's gone, under the current tax law. Some people think it'll be extended or renewed, but right now there's no official talk about that from any of the authorities.
Yeah, interesting. I know that it's probably very important to keep good records. If somebody comes to you and they don't have the documentation, I know usually you can find a money trail, but it is very, very helpful. And I wondered what kinds of record keeping you recommend, the types of things that investors should hold on to.
Yeah, absolutely. So for starters, bookkeeping is key. Bookkeeping is key to understanding not only the financial performance of your business, so how you can use your financials to make better financial decisions, but also for tax deductions. If you don't have good bookkeeping, you're probably missing out on tax deductions and not really maximizing your tax savings using real estate. So bookkeeping is key. Now, if you have one or two properties, you could probably get away with using like an Excel spreadsheet or Google Sheets.
Or a shoebox.
The proverbial shoebox.
Yes.
You definitely don't want to use that. You definitely don't want to use that in any juncture if you can avoid it.
Right.
But so once you kind of get to past two properties, you probably want to start looking at more official accounting software, like say QuickBooks Online. That's what a lot of our clients use here at our firm. And you want to keep that up to date, because that's going to be not only your audit trail, like I mentioned, not only your ability to save taxes, to maximize taxes and make good financial decisions, but if you try to wait till the end of the year to do that, or what I meant to say there is, if you wait too long, you want to do this proactively, right? You want to do this on a monthly basis, ideally, or quarterly basis, maybe, because you don't want to get to the end of the year and have to try to backtrack everything. So my first piece of advice is get bookkeeping in order. That's going to be like the foundation of your record keeping. Now, there are other strategies that you might be using. Like if you're using a vehicle that you're using for business, you're going to need to track your mileage, because that's how they're going to determine your how much you can deduct for your vehicle. So there's apps like MileIQ and other apps out there that can help you track your mileage, but you definitely want to be tracking your business mileage. Another thing is, if you have a home office, you want to make sure you have an outline for what your home office is, the square footage, a photo of that on file. In case you are ever audited, you can easily produce this information. So one of the key things under audit is how quickly can you produce information, right? Because that's a red flag. If the IRS thinks it takes forever to get it to them, they think you're recreating it or manipulating it. So if you can have everything organized and quickly produce this type of information, you're going to be putting yourself in a better position. So those are a few things. Now, we didn't talk about the real estate professional status yet.
I'd love to hear about that.
Okay. So I'll get into the documentation after I kind of break that down.
Okay.
So if you work 750 hours and more than half of your total working time in a real property trade or business, then you can qualify for something what's known as the real estate professional status, which allows you to take the losses from your rental properties against your active, say, W-2 or business income. So in other words, you can take that loss I was talking about before and use it to reduce your taxes. And I'll break this down further. But effectively, real property trades are businesses, just to be aware of what businesses can you be in to use this. You can fix and flip properties. You could be an agent. You can be a broker. You could be in development. You could be in construction. You could be in property management. These types of businesses, if you're working or just strictly rental properties, if you're able to meet those requirements, the 750 hours and more than half your total working time in these businesses, well, guess what? You qualify. And the thing is here, in order to really, this is one of the most litigated tax strategies in the tax code, because what happened was in 1986, let me tell the story real quick because it makes sense. So back in the 80s, you were able just to buy a rental property. Anybody could buy a rental property, and these highly compensated individuals were buying them up. And they were using these cost seg studies and all these other things to really increase that depreciation expense and use it against their income to significantly reduce their tax liability. And that became very controversial. And that's why in 1986, under the Tax Reform Act, they ended up putting in Section 469, the passive activity rules, which made all rentals passive. So basically, unless you worked full-time in real estate, you were unable to take those losses against your W-2 income. So today, the IRS knows, and let me just point the power of this, right? So if we go back to our example before, right? Let's say you had that $10,000 of rental income. And then you had that $6,000 of hard expenses, and then you had a depreciation of expense of $5,000. Well, if you use bonus depreciation, that $5,000 depreciation expense probably going to look something more like $10,000 to $20,000. So now let's say you're a real estate professional. Well, now that $10,000 to $20,000 can offset your W-2 or active business income. So if you made, just picking out numbers out of a hat here, $100,000 as, say, a real estate agent or, in another business, then you were able to, say, take that $20,000 loss that was, again, non-cash, so money didn't actually leave your pocket to create this. You're now only paying taxes on $80,000 of your income. So it can be much more powerful than this. We've seen people wipe out their tax liability using the real estate professional status. And because of that, it's one of the most highly litigated areas of the tax code, with over 500 tax court cases dedicated to just this one area.
Oh my goodness.
And the reason for that is because, again, the IRS's intent is to stop people who are not really actively involved or not really working full-time in real estate from using these losses, but people always try to do it anyway using the real estate professional status. So they get audited. And one of the biggest reasons why people lose these audits is because they fail to keep proper documentation of their records. Because, again, you need to spend 750 hours in a real property trader business and more than half your total working time. So you need to keep a time log and other records to substantiate that position. The time log is the pillar of your substantiation for that. If you get audited for a real estate professional audit, you want to be able to produce that time log quickly and efficiently, so that the IRS, believes that you really are a real estate professional and you're not just trying to, wiggle around the rules. So that's a pillar and why you need substantiation. In addition, the IRS could subpoena other evidence like credit card records and expense records and what have you, other eyewitness testimony. So you want to make sure that you have your bookkeeping in order to substantiate, hey, look, on this date, these were the expenses that I incurred. Because this is one tax court case, just to give you an example. The taxpayer said that they were working on their rental property, but they're on a certain date at a certain time. And the credit card records spoke differently. The credit card records said they were in like Paris. I think they were in Paris or London, like shopping at that point, at that time. And the IRS disallowed their position. So documentation for the real estate professional status is also key. So I know I just kind of went on a,
no, that's fascinating. So they go that far into an investigation or an audit to find out whether you're being honest and truthful.
Absolutely.
Wow. Hey. Boy, there's so much to learn. As I said, I'm going to say this again. It seems like it would be foolish not to be working with somebody like yourself if you're in the field of real estate. There's just too much for an average person to know.
I would have to. I mean, I know.
Yeah.
It's kind of. I agree. I agree.
Right. So I also noticed that you recommend that a lot of realtors become LLCs with their business.
Yes. So basically, real estate agents, right? So your commissions, usually you're self-employed, you receive a 1099 from the brokerage that you're working for. And that's subject to the self-employment tax. The self-employment tax is 15.3% up to the first, I think it's like $148,000 this year of your income. So what you want to do is you want to open up an LLC and receive that income through the LLC. And what I mean by that, to be clear, is the checks from your brokerage aren't being written out to Patty Teal, for example.
Right.
They're being written out to Patty Teal LLC.
Sure.
And whatever you decide to name your LLC. And the reason for that is there's something called an S corporation. And an S corporation allows you to pay yourself a wage, and you're only paying the self-employment tax on your wage and not necessarily the entire income that your S corporation generates. So But the problem is with the S corporation, you file a separate tax return from yourself. You need to do a reasonable salary analysis, which could cost some money to do. You need to file payroll, and there's some other compliance things that you need to deal with. So it doesn't always make sense to do the S corp when you just start out. So what the LLC allows you to do, the LLC allows you to start out as basically a sole proprietor, right? So the LLC by default, if you're the only person who owns it, is taxed as a sole proprietorship. So it's basically as if the LLC didn't exist for tax purposes.
So it's called a single member LLC. Is that what they call it?
Right. And that's just when there's one owner or one member of that LLC. And so you start off there, you report on your 1040 on Schedule C. So you keep your costs nice and low. And then if and when your real estate business, your agency or your brokerage really starts picking up steam, you really start earning a lot of money, usually somewhere around $80,000 more, that starts to make sense to do. You can make an S corp election on your LLC. So now your LLC is being taxed as an S corporation. You go ahead and you have your CPA, your tax advisor, prepare a reasonable salary analytics for you and determine what salary you should be paying yourself. And now you're going to be able to mitigate that self-employment tax because, for example, you might be making $180,000 per year. I'm just making up a number here. Sure. But your CPA may determine that paying yourself a salary of $90,000 is appropriate based on what your work is in that business. So now you're only paying the self-employment tax on $90,000 rather than paying it on the first $148,000 and then another 2.9% on the amounts above the 148. So you're really maximizing your tax savings with the S corporation. So that's why we recommend starting out with an LLC that's a single member, because you don't have to start filing the S corp tax returns and incurring all of these fees when just starting out. So you keep your business efficient, but then you also have the flexibility to go ahead and actually make this S corp election later on down the line, if and when it does make sense.
Right. Oh gosh, what great advice. And does it protect you at all from any type of litigation? I always hear that, but I don't know if that's really the case.
Yeah. So unfortunately, I'm not an attorney, so I can't give legal advice. However, what I will say is, from my understanding of how LLCs work, if you treat them properly, you follow all of the compliance related things and treat it like a legitimate business bank accounts. You keep good organized records. You have your bookkeeping done properly, then you're going to be putting yourself in a position that if you do run into legal issues, that LLC should separate you. Again, not an attorney, but this is my understanding of how it works.
Right. Oh my goodness. Did you learn all of this in school? Obviously, you've learned more since then. It seems like it would take a lifetime just to have all this knowledge.
Yeah, so I've been fortunate. I probably worked with somewhere between 200-300 clients one-on-one, and had to do a lot of tax research. So I have a lot of repetitions in this area, so I just have a lot of experience from it. But also, we've also had the pleasure of working with a lot of attorneys, so we also learn what attorneys like to see as well. So we can kind of help people set up entity structures that make sense, or help people strategize around entity structuring. In a way that we believe is not going to make sense from a tax perspective, but that what an attorney would like to see.
Absolutely. Yes. So where do you find your clients, or how do your clients find you?
Yeah, it's a great question. So we're fortunate. We have a really robust content marketing strategy. So we have a podcast, the Real Estate, it was formerly the Real Estate CPA podcast, but now it's the Tax Smart Investor podcast. That's our primary source of business. And that's exciting. We basically discuss taxes for real estate investors, business owners. We also have a blog, the realestateCPA.com blog. And then we also have a YouTube channel. We have a private Facebook group. So that's how we get a lot of our business. Obviously, we get referrals and we do webinars and things like this. But those are our primary ways we generate. We don't really have an outbound approach at this point that's really strong. So it's mostly inbound marketing.
And I noticed too, and I don't know if this is for people that are already taking courses or something, but you have tax questions live on Friday. Are you still doing that?
Yeah, so we have a group called Tax Smart Insiders, which people can go if they're interested. TaxSmartInvestors.com is where you could sign up for that. And we do 4 live Q&As every month. And people come, they ask their tax related questions. We're building an archive of all the prior live Q&As. So that's good for people who have a few tax questions or just kind of want to start seeing what's going on in their situation and what other people are asking about. We do those once a week. The next one's actually coming up Friday the 5th. I don't know when this episode will be aired, but that's the next one.
Oh, very cool. And I noticed you also have a short-term rental tax course, and so many people are into short-term rentals these days. Is that still being offered?
Yeah, absolutely. So the short-term rental task course is live and being offered right now at courses.taxsmartinvestors.com. Kind of give you a quick overview of why people care so much about short-term rentals. So if you remember what I said before, losses from your rental properties cannot be offset your W-2 or active business income unless you unless you have the real estate professional status, which requires you to effectively work full time in real estate. And if you don't work full time in real estate, or your spouse doesn't work full time in real estate, then there's a loophole around this. So if you invest in short term rentals, what short term rentals do is if you meet certain criteria, you're able to. It's not treated as a quote unquote rental activity under the tax code. It's treated as a normal business. And you can take the losses from a short term rental property, which could be a single family house or duplex or something like that, and use them against your W-2 or active business income without having to work full time in real estate. So it's a super popular strategy right now. Not only are what's the word I'm looking for? The investment properties of these of short-term rentals really strong, so people are getting a strong ROI on their investments. But there's also these fantastic tax benefits that a lot of people are utilizing right now, and we created a course around it that people can grab if they want it.
Wow. Well, I can't recommend you enough. There's just so much to learn. I definitely recommend you or some other expert to help in this way. Do most people take advantage of what you just spoke to, or are a lot of people missing the boat on that?
Yeah. So of the short-term rental strategy,
Yes.
absolutely. We're onboarding 30 clients a month right now, and half of them, or if not more, are using this strategy or want to use this strategy, which is why they're working with us. And then we've had another course we ran before this. We had over 500 students go through it, and now we have almost 200 students enrolled in this new short-term rental course, and it's growing every day. So a lot of people are able to take advantage of it, and it's super exciting to see it. And with bonus depreciation phasing out, starting next year,
Right.
the sooner you can use this strategy, or even whether it be the real estate professional status or short-term rental loophole to make your losses non-passive, the more tax savings you're going to be able to get. Because again, as bonus depreciation begins to phase out, the less powerful this strategy is going to be. It's still going to be powerful, I would say, through 2026, really. But again, it has diminishing returns as the years go on.
Wonderful. So if you wouldn't mind sharing your contact information again, not only your personal contact information, how people would get in touch with you. You already gave us your podcast and how they would find your blog and these courses, because they may be running for a pen and maybe they've got one now. So could you share that information?
Yeah, absolutely. So you can contact, I'm on Twitter, at Thomas Castelli _. You can search Thomas Castelli. I'm sure I'll pop right up. We also have the Tax Smart Investors Facebook group. If you just search for Tax Smart Investors on Facebook, you'll be able to find us. And then if you're interested in working with our firm, or you want to learn more about how we might be able to help you, the realestatecpa.com would be our main website to go to figure that, to kind of learn more about that. So that's kind of like in a nutshell where you'd be able to find me.
Well, I can't thank you enough. This is such important information. Thank you for being our featured guest on the Icons of Real Estate podcast.
Oh, thank you for having me. It's a pleasure to be here.
Thank you.